What if you wanted to invest in the real estate sector, but with twice the daily exposure? That is essentially what the ticker URE is designed to do. URE is the ProShares Ultra Real Estate ETF, and unlike a traditional real estate ETF, this fund uses leverage in an attempt to produce 2 times the daily performance of the U.S. real estate sector. And so far, in 2026, URE has produced a pretty significant gain. But before looking at the share, price performance, dividend yield, and dividend growth, there is something extremely important to understand about this ETF. URE is not a traditional buy and hold real estate fund, and that one distinction changes almost everything about how we should evaluate it. URE was launched in January of 2007 by ProShares. Its objective is to produce, before fees and expenses, 2 times the daily performance of the S&P Real Estate Select Sector Index. That index contains some of the largest publicly traded real estate companies and real estate investment trusts in the United States. Current holdings include companies such as Welltower, Prologis, Equinix, American Tower, Digital Realty, Simon Property Group, Extra Space Storage, and Avalon Bay Communities. However, URE doesn't simply buy twice as many real estate stocks. The fund also uses financial derivatives, including swaps, to produce its leveraged exposure. The goal is approximately 2 times the return for a single day. That word, daily, is extremely important. If the underlying real estate index gains 1% during a trading day, URE is designed to gain approximately 2% before fees and expenses. But if that index falls 1%, URE could lose approximately 2%. The fund currently carries a net expense ratio of 0.95%, which is considerably higher than most traditional index ETFs. Now, let's look at 2026. URE began the year at roughly $58.87 per share. As of the market close on August 7th, URE was trading at approximately $71.16 per share. That represents a share price increase of roughly 20.9% year-to-date. In other words, someone who invested $10,000 at the beginning of the year would have approximately $12,088 based solely on the change in share price, and that does not yet include distributions. That has made 2026 a strong year for URE so far. But share price return and total return are not exactly the same thing. Total return also accounts for distributions paid by the fund. ProShares' latest official month-end performance report showed URE's market price total return at 17.75% through June 30, 2026. Since the fund has continued moving since then, we can update the calculation. Using the August 7th price and assuming URE's 2026 distributions were reinvested, its estimated total return for the year is currently approximately 21.9%. So at the moment, URE's total return is slightly higher than its approximately 20.9% share price gain. URE also pays distributions quarterly. Over the trailing 12 months, it has paid approximately $1.42 per share, which gives the fund a current trailing dividend yield of roughly 2%. Its 2 distributions announced so far in 2026 were approximately 20.5 cents per share in March and 34.3 cents in June. That brings 2026 distributions so far to just under 55 cents per share. URE's one-year dividend growth rate is currently listed at approximately 10.9%. And according to dividend growth tracking data, URE currently has approximately 5 years of consecutive distribution growth, with its 5-year dividend growth rate averaging roughly 25% annually. Those numbers sound impressive. But there is an important warning here. URE should not be viewed the same way as a traditional dividend growth ETF. Because URE uses derivatives to achieve its leveraged objective, its distributions don't necessarily reflect the dividends being paid by the real estate companies in its underlying index. ProShares specifically explains that derivative contracts are priced to reflect the underlying index yield, but do not themselves generate dividend income. Because of that, URE's distributions can be very different from the dividend yield of the underlying real estate index. So even though URE currently has several years of distribution growth, investors should not assume those increases will continue. This is fundamentally a leveraged trading ETF that happens to make quarterly distributions rather than an ETF specifically designed to grow income over decades. And this brings us to the biggest risk with URE. The fund targets 2 times the performance of real estate each day, not 2 times the long-term return. Because URE resets its leverage daily, Compounding can cause its long-term performance to differ dramatically from simply multiplying the real estate sector's return by 2. Volatile markets can make this especially damaging. ProShares itself warns that the longer URE is held, the more its return can potentially deviate from twice the underlying index's return. So this is a much more aggressive investment than something like a traditional REIT ETF. Both gains and losses can happen very quickly. So let's review URE. URE provides approximately 2 times the daily exposure to the S&P Real Estate Select Sector Index. As of August 7th, its share price was approximately $71.16, up roughly 20.9% for 2026. Including reinvested distributions, its estimated year-to-date total return is around 21.9%. The fund currently yields approximately 2%, has recently recorded roughly 10.9% one-year dividend growth, and has about 5 consecutive years of distribution growth. But those numbers should be viewed in context. URE isn't really designed to be a traditional dividend growth investment. It's a leveraged ETF designed to amplify the daily movement of the real estate sector. That can create impressive returns when real estate moves higher, but it can amplify losses just as quickly when the sector moves in the opposite direction. Thank you for watching. If you found this breakdown helpful, please like the video, subscribe, and comment below with the next ETF you would like me to cover.